Hi, and welcome to this episode of Financial Planning Innovation. It's my pleasure to have on the line Michael Banner. Michael is a reverse mortgage expert. We've known each other for many years because we have strong affiliation with the long-term care insurance marketplace as well. And I really appreciate you joining us on the show today. Thanks for joining us, Michael.
Thank you for inviting me, Mark. Thank you very much.
So you're such a wealth of information about reverse mortgages, but it's not a common career path for a lot of people. How did you kind of get into the industry?
Wow, I can't believe how long ago it was, but it actually was for a relative. An uncle of mine died in a car accident way before he should have. And like many couples, he had the majority of the income in that generation. And my aunt actually said to me, I think I need a reverse mortgage. And even though I was the owner president of an FHA direct lender, this was 15 years ago, I actually said, I think that's a real piece of crap product. Don't they take your house? And she called me a Jewish name that rhymes with truck and starts with Shema and said, you better look into this. So I did. And what I found out just surprised me. And I got Aunt Iris a reverse mortgage. And to this day, in her mid-80s, she's still living off that credit line and didn't have to sell her house, even though she had lost 70% of her family income. And It was a very personal thing. And at that time, obviously, I didn't even know what a reverse mortgage was. And I owned a mortgage company with offices in a few states. Thank God I was the majority stockholder, because after the funeral, and I went home and I went back home. She was on the East Coast. I'm on the West Coast of Florida. Said to my partners, we're going in the reverse mortgage business. It changes lives. And they went, everybody hates them. I said, yeah, I did too 3 weeks ago, but I don't anymore. And that was almost 12, 13 years ago.
Yeah, it's important to know that these products are tools, and in the hands of the right expert who's really looking out for the client's best interest, you can come up with some creative solutions. So what are you finding that most of your clients are doing today with reverse mortgages? What's the most common use case?
Most common use, at least for the last decade, maybe even longer, has been to eliminate their existing forward mortgage. Sometimes at the same time, we eliminate that $30,000 car payment with a $30,000 car loan with that $600 car payment. But at minimum, 90% of people are doing this to improve their cash flow so they have more cash to spend on luxury and long-term care insurance and other things that are needed. So It's elimination of debt to increase disposable income.
So it's an interesting dynamic, right? A reverse mortgage is a loan, but you're using it to eliminate an existing payment. Can you give us like a high-level understanding of how exactly that works?
Absolutely. So many people, tens of millions of people in America, are very familiar with a HELOC, a home equity line of credit. They take a line of credit on their house. They use what they need when they need it. They have a maximum. They have a payment every month. Well, in most cases, about 75% of the cases, a HECM, a home equity conversion mortgage, is exactly the same thing. It is a line of credit on your house, except we give people 5 different options. They can take their money all at once. They can take it in pieces. They can take it on a certain schedule. They can have a lifetime payment. They can have a combination of all of the above. But there are 3 or 4 very unique qualities about a HECM as opposed to a HELOC. But the number one quality is ours doesn't have a payment or an obligation of a payment, I really should say, until you're dead. So every month you can make a principal reduction. You can pay the interest for tax benefits, or you can choose to defer till after death. And I've always thought that seniors on a fixed income, this is no point in life to take on more debt, at least no monthly debt. The reverse mortgage is certainly a debt, but it's a debt that will be taken care of after you leave us.
I see. And so it does apply more to the 62 plus year old marketplace.
Yeah, because you have to be 62 to get a reverse mortgage.
I see.
So That's it, 62 and above.
Gotcha. Okay. And I know there's a lot of misconceptions about reverse mortgages. Where would you see that a reverse mortgage makes sense versus a HELOC? Is it really age-based in a lot of ways, or kind of the differences there?
There's a few differences. It's age-based. It's most certainly income-based. There is a very big difference between a couple in their 60s and 70s, that is retired on $250,000 a year, and and has little debts and 6, maybe 7 figures in the bank. I get calls from people like that. I go, why do you want a reverse mortgage? Take money out of your money market at 0.5%. You don't want to borrow money. It's all about getting the right person to answer the question. But then there's mass America, what we all call mass affluent, that are retired, on 30,000 to 75,000. These are, 75,000 is not a terrible retirement, but it's not a time to add another payment. I mean, you have your house payment. You have probably at least one car payment at that age. You have your homeowner's insurance. You have your auto insurance. You probably have your life insurance. If you're 65 and above, I bet you have a Medicare supplement policy. Seniors in mass America are basically insurance premium to death, but they need those products. They're great products. So saying, you know what, I think I'll take a line of equity. So it'll be another $200-300 a month. That's not the time. I think that's when a financial planner who knows the strengths of the reverse mortgage can step in and go, no, this is not the time for more debts.
So I guess you can think of it as a funding source. It's an asset. The home equity is an asset, and you're using this funding source in a more flexible way, as long as the person knows how to use it. So tell us a little bit about the idea of funding insurance. Specifically, there's a law that's passed that doesn't allow you to use a reverse mortgage to fund an insurance product. Can you tell us a little bit about that and that background there?
Without being political, I'm going to do that just for you. Usually I get very political when it comes to this. In January of 2009, actually February of 2009, President Obama signed into law HERA, the Housing Economic Recovery Act, the massive bailout of Wall Street. President Bush introduced it late 2008. President Obama signed it into law. Many people were against it, but it had to be done. Wall Street was failing. Movies too big to fail, things like that. We had to save Wall Street, unfortunately. We're even going through a little of that now, which I disagree with, but we won't be political. As part of HERA, this 7,000-page bill, the reverse mortgage industry was absolutely expecting some new guidelines. Unfortunately, a segment of our industry, a very small segment, because we're a very noble industry. You had a guest just recently, Stephen Sless, is just an example of how noble this industry is. Just a wonderful person. Just does so many great things for our industry and his clients. But there was a small section of our industry, unscrupulous reverse mortgage people who got together with unscrupulous insurance people and unscrupulous financial planners and were convincing seniors to take equity out of their home to buy annuities. And at that point in time, at most points in time, the interest rate on the reverse mortgage was higher than the rate of return on the annuity. Why would you ever borrow money at X to invest in something at less than X? It should be illegal. It was most certainly immoral and unethical, but it was being done. Not tremendous, but enough to get on the radar of the CFPB, departments of insurance of various states. And of course, when mom or dad or grandma or grandpa said to these type of people, well, I don't understand, why am I borrowing money in the 4s to buy an annuity in the 3s? Does that really make sense? There's no payment on the reverse mortgage anyway. Come on, you're going to be dead before you make the first payment. Give me $250,000. I'll give you a 4% return, 10 grand a year, $833 a month. Wouldn't that help you live? Well, yes, but they would have been better off just to get the reverse mortgage and take the money out of the reverse mortgage. The only people that did well on that was the people making 5, 6, 7 points on that annuity. And it was wrong. Like I said, it was immoral and unethical at best. So we were truly expected, as part of HERA, a regulation that said the use of reverse mortgage proceeds is no longer allowed for the purchase of annuities. And we were happy with that. It was a stain on our industry, on an otherwise noble industry. Unfortunately, to our dismay, a certain political figure, which we will not mention in this interview, created a last-minute section 2122 of HERA, subsection, I think it was 255, that said the proceeds of a reverse mortgage cannot be used for any insurance product.
Mm.
And this just put many, many people on a national level into a spin. Keeping in mind this was early 2009, MetLife, one of the largest long-term care insurance industries, was establishing itself as one of the largest reverse mortgage companies in the world. Genworth, I think at that time may have been the top or number two long-term care insurance industry, had just bought a huge reverse mortgage company. And it was their plans to train their tens of thousands. In fact, in MetLife, I think it was a little more than 100,000 agents, that when someone said, oh my God, I really need this long-term care insurance, it'll protect us for the rest of our lives, and we'll never have to go into a nursing home, we'll be able to stay home. Oh, isn't this great?
Mm-hmm.
But we can't afford it.
Right.
And we wanted the ability to say, well, may I ask, do you still have a mortgage payment? Well, yes, I do. Why? May I ask, how much is your mortgage payment? $1,400 a month, $1,200 a month, whatever. Well, if we eliminated that mortgage payment, your long-term care insurance premiums are well below that. Would that make it easier for you to afford it? Or a second choice may be, do you have a mortgage on this home? No, I don't. Why don't we get you a line of credit that has no monthly payment for as long as you're alive and help you afford your long-term care insurance with that? This is what we were supposed to be doing 12 years ago. This is the way we were supposed to be getting literally millions of seniors who otherwise didn't think they could afford long-term care insurance, the ability to have it. And this very poorly written, amazingly ambiguous law, the ambiguity of it is just staggering. In one paragraph, it says you can't do that. In another paragraph, says you can do that as long as there are certain safeguards in place, but they don't list the safeguards. In another paragraph, it says you can't have any relationship with these people. You just get done reading it, and the compliance person of any good reverse mortgage company or any good insurance company goes, we're just staying away. I mean, this is just, and it scared both industries for the last 12 years. And
Yeah,
it's just terrible.
And it's still kind of a topic today. We talk about suitability a lot with insurance products. It's very important that this is in the customer's best interest and fiduciary responsibilities. But, funding sources come into the mix, and it's hard because everything's fungible into cash.
That
right?
word, yes.
And so it's about, where is this funding coming from, and regulating, are you regulating now where this money is coming from? It's a very sticky topic.
It is.
But you had mentioned there is kind of something being developed now, and this is kind of the innovation side of this. Obviously, those are for federally insured mortgages.
Yes.
Tell us a little bit about what's coming out that's allowing people to be able to use these products and have more flexibility around how they're using that as a funding source.
Exactly. Yeah, with all the ambiguous language in that law, one thing is 100% clear. This law was written specifically for the HECM, home equity conversion mortgage, insured FHA reverse mortgage. That's what these rules apply for. Now, approximately 18 months ago to 2 years ago, because the reverse mortgage industry was seeing its own changes from the Great Recession and homes losing their equity, several major institutional investors have come out with proprietary reverse mortgages that are not insured by HUD or FHA. They have the same great qualities. They're non-recourse. You can never outlive them. There is no MIP on them, which actually saves a tremendous amount of money for people up front. There are no payments due in their lifetime. And one of the most important qualities is where we lost the jumbo reverse mortgage about 8 years ago. Lehman Brothers was funding jumbo reverse mortgages. When they went away, so did the jumbo reverse mortgage. Right now, the maximum reverse mortgage, it's gone up every year, knock wood, it's about $650,000, okay? We now have reverse mortgages up to $4 million. And you'd be surprised how many our industry is doing for people with that $3-4 million house that wants to get rid of that $2 million mortgage and fund a long-term care insurance policy and save themselves $5-6 grand a month. So it's opened up a totally new door. I wish we had You talk about suitability. Uh, Why our industry, reverse mortgages, doesn't have suitability clauses like yours does is beyond me. We like to think we act in a fiduciary manner, but we're not fiduciaries. But, the best of us try to act like that. But there's no doubt about it. You can use a proprietary reverse mortgage to help afford either a traditional long-term care insurance product, to fund a single premium life product with a death benefit, that's incredible, and a multiple with a long-term care rider. There is just great things we can do with this proprietary product.
So when people out there, and financial advisors in particular, we hear proprietary, sometimes we think that there isn't as much competition, or maybe the actual cost of the product is higher. How does it compare to the federally insured mortgage world?
There's no doubt the interest rate is higher. There's no doubt about that. It's still highly competitive. But as I mentioned a few minutes ago, there is no MIP. That's what on every FHA loan, whether one of our children buy a first-time home with FHA or our grandparents get a reverse mortgage. In the reverse mortgage world, the MIP premium is 2%. Doesn't make a difference what you're borrowing. And it's not 2% of the loan amount. It's 2% of the value of the home. So you come to me and you have a $600,000 house. You only want to borrow $200,000. You want to pay off your mortgage. You want to pay off your BMW. And you also want to be able to afford a long-term care insurance premium. In fact, you want to up your life insurance because you're still healthy. And before I get into closing costs on that mortgage, before anything, your house is worth $600,000 times 2%, $12,000 insurance premium. And the financial planner looks at you and goes, Michael, anything past that, the upfront, the front load, to put it, in insurance languages, this is terrible. These people can go get an equity line for $500 in Wells Fargo. And you haven't even added the closing costs yet. The title policy, the appraisal, the survey, the recording fees. And that huge upfront insurance has been scaring away clients forever. So we don't have that in the proprietary product.
I see. So the MIP, the mortgage insurance premium, is kind of baked in. All the costs are baked in, which is why it has a higher interest rate.
Yes.
But if you compare it apples to apples, they're much more in line with each other.
I just recently, obviously, for privacy's sakes, I would never mention, address, names, or real details. But I just did a $800,000 reverse mortgage on a $2 million house at a very, very competitive interest rates with no points. Okay. And I gave a $20,000 credit at closing. She literally paid for her appraisal. We paid for everything else. We paid off a $500,000 mortgage, which saved this client about $3,500 a month and gave her about $300,000 cash out.
Really. And I think at the end of the day, that's kind of what this is about, is work with experts and professionals in these arenas, do what's best for the client, which is obviously, you're having individual consultations and figuring out what do they really need here.
Yeah.
And really appreciate you sharing with us. So this
Thank you.
And hope to have you on future episodes too.
All right. And let's tell your audience you're going to be a regular on my TV show, which you've already been on. Absolutely. So, we'll look for that too, because we love having you as a guest. And congratulations. We talked when you started this, what it's become is incredible. So heavy kudos and congratulations.
I appreciate it so much. And we'll have you on future episodes too.
Absolutely.
All right.
Stay safe, you and the family.
You too. Talk to you soon.
Bye-bye.